All right, we should be ready to go. So hopefully everyone can hear me. If you can hear me, if someone could just say in the message board, just say you can hear me, that'd be great. I had a couple of technical difficulties getting in tonight, so hopefully it's all working now. Anyway, I'll be doing a solo one tonight. My name's Thomas Atkinson. I'm from FX Evolution, and tonight we're going to be taking a look at the secrets the big banks don't want you to know when trading trends. So we're actually going to be having a look at a few of the things that I guess we've learned over the years through our contacts in the industry, and also just things that like kind of helpful tips and tricks that can help you as traders that you may not know, you may already apply, or at least it gives you the confidence to use those techniques. So just to get started, we obviously have the risk warning. The information provided in these videos has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification, and of course it's general advice only. So what are we going to be taking a look at today? We're going to be having a look at how to correctly identify trends using a simple moving average or an EMA method. And I'm sure many of you are aware of what a moving average is. It's one of the things that a lot of people use when they first start trading. We're going to be taking a look at recognizing areas where take profits and stop losses should be placed. We'll be using a bit of support and resistance for that. It's one of our go-to things at FX Evolution. And we're going to be taking a look at what market conditions to look for before placing a trade. Also, we'll be taking a look at, within that, some of the news that you may not need to worry about potentially with market conditions when you're trend trading, because it's a little bit different to when you're scalping. Some things you need to worry about, some things you don't need to worry about. And of course, then there's 5 tips and tricks that help you better analyze the charts and a Q&A session. So hopefully the guys from Pepperstone will be able to get a few questions by the end. Laurent might be able to get a couple of questions that you ask in the room. So any questions that you ask, please do ask them throughout the webinar. And at the end, I will do my best to answer a few of those and hopefully give you a little bit of our insight into some of those answers. So what is trend trading? I mean, many of you guys will know, basically, of course, trend trading is that we're picking a direction and we're hoping that it goes up in that direction or it goes down in that direction, depending on whether we're buying or selling. But what we need to be aware of when we're trend trading is that generally trend traders will hold positions for a longer period of time. Now, if you're trend trading in 1 hour chart or a 4 hour chart, you may be only holding it for a matter of maybe a day, maybe 8 hours, maybe just a couple of trading sessions. But if you are trading a daily chart, you could be holding these positions for days, if not potentially for weeks. And that's something a lot of people don't do when they first start, when they're trading currency or commodities. They'll often be in and out very, very sharp. They'll be on the 5-minute, 15-minute, they'll be trading those kind of trends. And that's fine. But what we need to recognize is that most of these bigger banks and most of these big institutions, the way they're trading is that they generally will hold positions for a longer period of time. And what they'll do is they'll scale in to trades and they'll scale out of trades. So that basically means that if I was placing a trade and let's say I was employed by a big bank, what they're going to be doing is they need to make money. Otherwise, of course, they're going to be fired because at the end of the day, if you don't perform, you're out the door. But they also need to be able to move large sums of money. So while we might be trading 1 lot or 5 lots or 0.1 lots or something like that, what they're going to be doing is they're going to be trading potentially hundreds of millions of dollars in and out. And they therefore need to scale into their orders within the trend. So it's very important that we understand that they're not just trading these 15-minute, 1 hour charts. They're generally trading the larger timeframes. And then as they see confirmation within the trend or the swing within the trend, they are adding to those orders and therefore they're also scaling out of orders. So you'll hear that a lot if you ever talk to people that trade huge sums of money or they trade managed funds or any of those types of things. If you've ever been to those kind of seminars, they may talk about scaling in and scaling out of orders. And that's what we need to be aware of when we're trend trading because it changes the way we approach the market. Another thing that's great about trend trading is it's a great type of trade for people with busy lives. I'm sure we've all got the cousin or the uncle or somebody that's bought a house or they've bought a bunch of stocks and they've forgotten about them and then they've come back 20 years later and they're all of a sudden potentially even worth like $1 million and they didn't even know about it that much. And that's because they've bought appreciating assets over time. So they've bought those particular positions, they've gone up over a long period of time, and effectively they were trading a trend, and that trend was based around inflation. So the great thing when we're doing currency trading and we're trading within the Pepperstone platform is that if we're trading, we'll often have the positions open for a longer period of time. And you'll find that little bits of news as well. So the news that comes out during the week, that will often help a trend because it kind of adds on value. We'll talk about that adding on of value a little bit later as well. But that add-on of value effectively means that we are able to stay in the trade for a longer period of time. And therefore, if we're working 8 hours a day, we don't need to be checking the charts all the time. We can just come back, check it once or twice a day, have maybe some mobile alerts or some email alerts set up, and that's the way that we can deal with it. So it's really, really great for people that have busy lives. We love teaching people how to do trend trading if they don't have much time at home and they've got a family. That's the kind of trading you want to get into. Maybe less of the scalping. The other thing about trend trading is it means less transactions, but often high quality. And that comes down to your psychology. So again, the big banks, the other big traders out there, they know the kind of traps that most beginner traders come into when they first start. As I said before, we all start with a 1 minute, 5 minute, 15 minute chart. I'm sure everyone can feel that, and they know that out there. You've all started at those timeframes generally, and the big banks know this. So what they do is those particular types of timeframes, you get stopped out a lot more. And even if you're practicing really good stop loss and take profit techniques, sometimes you'll get just spiked by a couple of pips and then it'll go in the opposite direction. So we'll talk about a couple of ways of getting out of that. But when we're trend trading the bigger timeframes, often because we're going with the trend, we'll get higher quality trades, and that will help our psychology so we don't have that problem where you may be losing 7 or 8 or 10 in a row when you're scalping, and then all of a sudden you're winning 10, 15 in a row. It'll be more consistent. And sometimes for a lot of people, consistency is key. Also with trend trading, typically they follow the trends of the daily and the 4-hour chart. So we talked about that a little bit before. 4-hour and daily is really where trending is at with currency trading. We love it. That's where a lot of swing traders are as well. And that's where we've seen most of our success over long periods of time. Some of you guys have also probably heard of the trend is your friend phenomenon. And this couldn't be more true. Trend is definitely your friend. Like when we said before about the person that might have bought stocks 20 years ago and come back, they might have bought blue chip companies. Those particular companies have gone up over time, and that trend was up because they were trying to make more money for the company. So just like that in currency, when a trend is on, it's very, very quick, and often it can be very explosive, and all of the little bits of news that are coming out will help that trend generally. And therefore, it really is your friend. So you'll have a big success when you trade with the trend, like a daily trend, and you'll have a lot less success if you try to counter against that. So you really want to stick with trend if possible. So I think we'll jump into the charts just quickly, and we'll talk about moving averages in just a few minutes. But what I want to do is just show this pound US dollar chart. And the reason I want to show this is I've got 3 EMAs on here. So I've got 3 moving averages on this chart. I've got the red one, which is a 21. I've got the blue one, which is a 55. And then I've got this green one, which is a 200. Now the 200 is one of our favorite SMA or EMAs in the market. And the reason why is it kind of helps us to be able to determine trend very, very easily. There's actually a really top tip that I once heard, and I've applied it a lot over the years, and that was that if price was above the 200 moving average, then we'd be looking more to the buy side, and if price was below the 200 moving average, we'd be looking more to the sell side. So that means that when it crossed through this point here, we'd only be looking for sells on the daily time frame. And I think a lot of you can see, if we go back through, look at how few times it's broken recently above this 200 and been incorrect. So again, with this one, we would have need other reasons to be involved at this point. But look at this 200. Look how long that trend's gone for. And then look when it broke through here, look how long that uptrend's gone for as well. And then of course, recently it broke through and now we're seeing the continuation of that trend. So if you're going to take anything away from the lessons today in this webinar, it's really do pay attention to the 200 moving average. It's heavily used in the industry. The big banks use this moving average, and you should have it on your charts, especially with the daily, because that's where a lot of the guys do trade, and the daily means a lot. So when it crosses through this, if you're seeing UBS or Goldman Sachs or any of these daily reports, or you have a Bloomberg terminal or all those types of fancy things, that at the end, in those particular reports, they often mention the cross above or below the 200. And whether that's an SMA or an EMA, they're going to be very, very similar in terms of where they are on the charts. And we'll explain that in a minute as well. But the point is that when it crosses, it's a big deal. So I think that the pound is a really good example of what's happening at the moment with that. Okay, so step one, I guess, of successfully trading would be the top-down approach. So we talk about this a few times over the last couple of weeks, and we'll just continuously hammer it home because it's so important. And that is that most banks and most big traders out there will start with a higher time frame, like a monthly or weekly, and then they'll work down through that to get an overall picture of that particular currency, because they want to know where the big key supports, the big key resistances, and of course, whether the price is above or below things like that 200 moving average. We also want to recognize a trending or range-bound market. We can do so by things like recognizing channel patterns. If any of you are not familiar with channel patterns, you really should look those up. They're a heavily used pattern. It's something we use a lot at FX Evolution to trade all sorts of different commodities, currencies, doesn't really matter. Those particular patterns mean a lot to everybody out there. And of course, they also help us determine whether trend has started or not. We also want to use line, bar, and candle charts. So don't fall into the trap of just using one. In fact, when we're looking at trend, often looking at line and bar charts is more effective because it kind of cleans up the screen. So when we're looking at the charts, if we see, let's say, a line chart, it's going to be very, very clear what the trend's doing. And when we have that with the 200 moving average on it, it's going to be even clearer. And we'll do that together in a minute to show you. Other thing to start with is kind of like the blue chips of currency. It's always good to start with things like odd US dollar, euro US dollar, pound US dollar, yen. That's where most of us start. And that is where you're going to kind of cut your Forex trading journey. You're going to start with these things and you'll never probably stop trading these particular pairs, because everyone in the world's trading them, because these are the majors. These are the blue chips of currency. Another thing that a lot of the big banks look for is they'll look at those multiple timeframes in terms of that top-down approach, but they'll also be very aware of what's happening either side. So here we have a 15-minute chart, and then here on the right-hand side, we've got this 4-hour candle. And many of you guys will know, and we'll talk about this candle later on, this is what they call a shooting star candle. So on the 15-minute chart, while we might be seeing a change of trend and all of those things happening, on the 4-hour chart, we're seeing an incredibly bearish candle signal. And we want to be aware of those. So if we're trading a 15-minute and for some reason we're looking at buying down here and the 4 hours closed and it closes like that, that may not be the best idea. Because where is the bigger money? The bigger money is on the 4-hour, daily, weekly timeframes. So if they're seeing a signal like this, your little 15-minute scalp is not going to do so well if it's down here at this support level. Let's just quickly jump back into this pound. So as I said, if you put on a line chart, what you'll notice is it just really clears up when you're looking at things. So if we start at a monthly and we were looking at this monthly and we were just wanting to draw up our basic support resistance, I think a lot of you would be able to see these very clear points of resistance and outlier points. And we talk about this where we like to break it down. We have a color, let's say, set up for the monthly. And a lot of the big bank guys do this. They'll have a specific support resistance color for their monthly support resistances, and then they'll break it down. And what we saw recently with this pound, look how this pound came up And see how this was previous support, it was previous support here, it was previous support in this area, and then that suddenly became the resistance point where the rally to the upside on the daily became now the rally to the downside. So that's why it's so important to look at these monthlies, because if you're up here scalping a 1 hour chart, I know monthly doesn't seem that relevant to 1 hour, but all of a sudden, maybe we shouldn't be looking at little bit longer term buys here, 1 hour, 4 hour daily. Maybe we should be looking more to, is there any other signals telling us to short? Because this is a very key level where we expect weakness. We expect the big banks to be taking their positions here. And this comes back to that scale-in question we had before. If we're seeing the market going up like this, the big banks have been placing their trades to the upside. They've been buying the pound. Where do you think they're going to start scaling out of their orders, or at least taking profit? The obvious choice for them with their millions of dollars is going to be at the first major point on something like a weekly, monthly chart. And that's why here, if we break this down further, is going to be a point where the market will have reached it and found quite a lot of resistance. So let's just break it down to a daily all of a sudden. Look at what happens here. I'm starting to see a bit of a pattern going on here, where at this point, a few of you will be able to recognize, look at that, it's a double top. And that double top broke, and then soon after that break, the price went under the 200 moving average. So even if you didn't know how to recognize this pattern, at some point, and the point being when it broke underneath this would be a great signal for you to start to look for the scalps or the smaller time frame trends to the short side. And if you just come in at some point, just press the sell button and it's under the 200, well, guess what? If you came back many, many months later, you'd be up 10 cents. Or 1,000 pips. So the 200 on the daily really plays a huge role into what determines or what's happening in the market. And hopefully that makes sense to a lot of you guys out there. So step 2 of some of the things we want to do. Of course, we'd love to trade the 1 hour, 4 hour and daily charts. This is where a lot of the nimble kind of trend traders or swing traders are. And this is what the big banks do. And it's why we always talk about this. They may trade up to the weekly, but of course, we want to have a little bit more trades, and we don't need to deal with the kind of money and the scaling in and out of orders that they do. So we can be more nimble and we can be quicker. And I don't know if many people have seen this out there, but sometimes there is a problem of where you have too much money. And you'd be surprised, you actually have an advantage having a smaller amount of money. And when I say too much money in the currency world, that's not even 10 million, 20 million, $30 million. We're talking hundreds and hundreds and hundreds of millions, if not billions of dollars, because it's such a big market. So we really have this advantage of being able to be nimble and quick. And that's why we can use daily, 4 hour, 1 hour. And that's really where some of the best trend trading happens. Generally, if we stick to these timeframes and you stick to blue chip kind of currencies, you'll be able to find around 3 to 5 good opportunities per week. And this selection is, from only about 10 to 20 pairs. Now, that may not sound like much to a few of you guys out there, but if we're finding 3 to 5 great trades, we're having success, let's say, of 3 of those 5, trend trades generally are going to make us more than 1-to-1. So if we were risking $100, then our reward is most likely going to be more than $100, or it should be in our trade plan. So that's something very, very important to look at. We can always consider, of course, back testing our strategy, and we can spend time learning the way the market moves. So the time of day, how the currency reacts, become like a master of your currency pairs. Of course, in Australia, we're a bit of a master of the Australian US dollar, and that's one that we've always traded, we always will, it's close to our heart. If you're in London, you might become a master of the pound. And of course, at the moment, the pound's very volatile and there's a lot of traders on it. So here we've got the moving averages. I didn't want to go too much into this tonight because I think there's so much information out there and we've covered it before. But basically the idea is that the smaller moving average or the faster moving average is the one that we want to cross above or below in terms of giving us a signal to go long or to go short. What I'm telling you tonight is, though, if you do see the moving average cross, and then so it crosses up here, and then price goes through that 200 moving average, that's even a stronger signal that the trend will probably continue on. So we see the cross here, which actually is equal to around this candle here. And then after that, we see it break through the 200, it pulls back a little bit, and then the trend is on. And we can see here how it respects the 200 the next time it's touched and doesn't quite break through it. So the 200, put it on your charts if you don't already have it on there. Okay, another big problem a lot of traders have, stop losses. I think we've all been there, we've gotten stopped out. We have massive problems with this, and it's something that I think every trader struggles with. So market adaptive stops are incredibly important, and most people don't think of anything this way. We always think when we first start trading, we think, let's have a 50 pip stop loss. And in every single trade, we have a 50 pip stop loss. We just select it, or a 20 pip stop loss, or a 15. And you kind of change the stop loss based on the time frame that you're trading. So if I'm trading a 1 hour or 4 hour, then of course I'm just going to have my fixed stop loss for that particular time frame. The problem with this is the banks know this. They know what people like to do, and that's because generally we love 5s and 10s. So if you look at the human kind of psychology, we love $100. We love that round number. We love the 1 cent. So when you see like a currency move from 70 to 71, or a stock move from 32 to 33, it's a very psychological number. I know firsthand, if someone calls me and they say, I want to close this position, they'll always want to close it on that round number, okay? So if it's, let's say, 72.55, they won't want to take 72.97, they'll want to take 73. They always want to do it that way. And the banks know this, so they also know where to place stop losses a lot of the time. The best thing to do is if you see something like a candle or a place that you want to place a stop loss, what you can do is you can take the distance of that particular candle, work that out into a percentage. So let's say this was 100 pips long, and then we can put the stop loss, let's say 10 to 20% behind it. And what that does is it gives us a market adaptive stop. So depending on how big this candle is and how big the range is, we can then change our stop loss. And the real benefit of that is, in most theory and in most things you'll learn online, you'll learn anywhere at like kind of around the places, people will say, put it a few pips behind. The problem is, who knows this? The banks know this, and they'll stop hunt that particular thing. So if we're having a look, let's say, at the markets, and I think I had a good example. Where did I have that? I had it before. We could really use anything, so we'll just use this particular thing. If we had, let's say, our trade here and we had a stop loss up here, what often will happen is people will just place their stop loss just a few pips above, and then this wick in this case didn't go above, but it generally will just go a couple of extra pips. It might go sometimes 5, it might go sometimes 7, it might go sometimes 3. The point is, if we have that market adaptive stop, what ends up happening is that it's less likely to hit you. So it's less likely to become a problem to get you stopped out. So if we take the distance, let's say it was this particular candle here, this particular candle, 67 pips. So what we would do is we'd break that down to a percentage. We would want a 10% extra stop behind, which would mean that we would need 6.7 pips behind this point. And that keeps us agile and keeps us in the market, and you'll be surprised how often that works. I like to use 15%, but some people use 10 to 20. I like to be on that cautious side. So that will stop you getting actually hunted a lot by having that market adaptive, and it's a really, really good top tip. Another thing that you can use, of course, within trend trading is Fibonacci retracements. The big traders, the big banks, they use this. We've covered this quite a few times before, but if you need to, go learn about Fibonacci retracements, because it's something that's used heavily by the big banks and you should be paying attention to it. So step 3, we want to optimize our entry. We want to enter based on confirmation, not on gut feeling. I think that's an obvious one. We want to stick to our plan. We don't want to break even trades with fixed pip amounts, use percentages. So that's what we were talking about with that candle. We want to break it down to percentages and then change our stop losses to those percentages. And we want to spend time learning the way the markets move. So just like we said before, way they react to news, way they do other things. I had a student the other day, and what he was talking about was, he said, oh, I've made a mistake. I was trading, I think it was the rupee. And I said, why are you doing that? Because for him, he didn't understand that market. He didn't understand that it's going to react heavily to certain bits of news, because the liquidity and the size of that particular currency trade is not as big. So when that big news came out this week, all of a sudden it reacted heavily to it. And then he got really hurt from that, because he didn't think about the way that the market moves within those currencies. So my top tip to everybody out there is, if you're trading, try to stick to maybe the big majors at the start, and then as you get confident in your trading system, spread out and start to learn new different currencies, but become a master at everything if you can. Of course, then we've got role reversal. That goes hand in hand with that moving average above the 200 or below. We've covered that several times before. But what I want to do is I want to stick to things like market conditions we look for. So one of those is that trend often starts with volatile news announcements. We're seeing that right now on the pound US dollar. What happened to the pound US dollar this week? We had that major news coming out. Obviously, Theresa May was not able to put that particular vote in, and that caused the pound to go through. That's the volatility, and then it broke this very key support line. And this continues on now potentially until the market reaches the next zone. So maybe the market has to go, it's broken all of that now, maybe it's going now more down to this level. Maybe that's what our analysis is telling us. So we're now able to jump into the smaller time frames and look for short opportunities. That's smarter than probably buying it at this point statistically. We could also look for a retracement to this point and do a role reversal kind of trade in the direction of trend. That's what we want to do, and that's what the big traders are looking for. Often they'll look for things like a pull up of this trade where it comes back to this point. They'll look for a short signal, they'll get involved, and that's what the big banks do. It's not smart just to say, oh, I've seen this break, it's all the way down here, I'm going to sell it, but my expectation is it's only going to go down to this point, because what's that doing to your risk reward? You're not going to have success like this. And again, this is what the big banks know. They know we do it. Quick, easy 50 pips, quick, easy 100 pips. We've all been there. We've all done it. I've done it before back in the past. It was when I was learning, and it was, very bad mistakes that you don't want to be making. But hopefully that makes a lot of sense to everybody. Often the market will gravitate towards very key daily, weekly, monthly support resistances before super big news comes out. And then that news will either break it each way. We don't want to preempt what it's going to do, but when it does do it, we want to start to look to get involved with that particular pair. So of course, examples such as US election, when Trump got elected, there was some massive volatility in the markets. Again, resistances and supports were broken, and it created a trend that lasted quite a few months after that. So these massive bits of election news and stuff can break key support resistances, break past 200 moving averages, and then start that trend that we're looking for. The Brexit and non-farm payrolls. When we see a big non-farm payroll, and for anyone that doesn't know what that is, it's usually once a month at the start of the month on the Friday in the US, and it's their jobs figures. And that's one of the biggest pieces of news that happens during the month. So you always want to be paying some attention to that one. And of course, when we're trend trading, we want to practice discipline when looking for the trades. So let's kind of end this step 5 part with 5 tips and tricks. So when I say the first step, which is news is mostly noise, realistically, the big news like those elections and those non-farm payrolls, as a trend trader, we need to pay attention to those because they are going to break those key support resistance levels. But what about the yellow news or the red or the smaller red news, like maybe some CPI or something like that out of one of the currencies we're trading? Will that really make a difference to our daily trend trade? A little known fact is that generally, while it may make it a bit volatile, because we're trading the daily or we're trading a bigger time frame, it usually won't move the currency unless it's an unexpected result too much. And often that will actually push the market into the direction of the trend. Because when we understand what's happening with, let's say, interest rates or monetary policy, every one of these little bits of news is meant to be a stacking effect to potentially go towards the next interest rate rise or drop. So if a level is broken by some volatile news, that level's been broken for a reason. Every bit of news after that most likely will probably be at least partially agreeing with that trend. So we can actually ignore that if we choose to be technical only traders. And some people don't want to do that, but that's a great way of being. It means you can focus on the charts and it will help your trade. You'd be surprised when you follow it for a long time. You'd be surprised how much it helps it. So trading done properly can sometimes be boring. We hear this all the time. I know for a fact that a lot of students that we teach, they do find it boring without being able to, let's say, send us their trades or being able to share what they're doing. And that's because trading can be solitary. So, and also it involves so much discipline. So sometimes we're going to have to sit there and we can't just get the quick, easy 100 pips because it doesn't make risk reward sense. Again, the banks know this, and it is about being really, really fast in the market. And that's what you want to do. You want to make the 100% within 2 weeks. But the problem is it is that slow kind of methodical way of trading that's the best. And that's the one where you can be here in 5, 10 years, 20 years, 30 years, and you can still be compounding your profits because you've practiced the discipline. So it can be boring. It's normal. If you sometimes say, oh, there's no good trades today, how can that be? Sometimes there really is no good trades. And the big banks, they definitely aren't trading all the time. While the market is moving all the time, there's a lot of other things that go into currency, not just them trading. There's transactions, there's business transactions, there's all those types of things. So we must be aware of that. So you must plan the trade and trade the plan. Hopefully this makes sense to a lot of you guys out there. If we have a trade plan and we place the trade, then we must trade what we've said. Do not break those rules. If you break those rules, you set yourself down a path of losses and not being consistent. And of course, then the last 2, the market is a really bad teacher. What I mean by this is if you lose money or make money, worse actually, if you make money, let's say by selling the pound right now, and like in this example here, our stop loss is up here, but our take profits down there, and it doesn't really make sense. Yes, I could make money, but that is actually a really bad thing. And by doing it that way, I'm probably going to do it again. So you'll hear a lot of people say, oh, the market's taught me, and the market's, I've learned from the market everything I need to do. The problem is you often won't learn from these things. So it's about trading that trade plan more than anything else. And of course, the market doesn't move on your time frame. So what that means is you can't just will it to happen when you want it to. All right, so let's take a quick look now at a few of the trades in the market at the moment and just talk about if these particular levels broke, what could be potentially causing these things to break. So one thing was, and we mentioned this in our webinar that we've run, our FX Evolution webinar, and if you want to join that, you can just log on to fxevolution.com and join our webinars. But we were talking about this on our weekend analysis, and we're talking about the break of this key level. Now, it's interesting that the euro pound broke this key resistance coming into a big week, of course, in terms of the pound. So it broke. It actually gave us that early signal saying, okay, we could potentially buy here. If we were placing a stop loss, the safe stop loss on something like this would obviously be under here. But from a bank trading perspective, what we could also do is we could take the distance of this, break down that to a percentage, and then place our stop loss behind this candle here at a certain percentage. And that will also give us a very good statistical stop. The level's broken, the safe stop's here, but there is another stop here that we can place. And it will take a lot of money to be able to break past this point here. Be surprised. There'll be a lot of orders trying to push the market up and keep this pattern going. And a few of you may realize as well, what has happened to the 200 moving average? Well, it's not been doing much. Our moving averages have crossed the 21 and the 55, and price is above the 200 daily. So we probably should be looking at buys. So it's this concept of a few things coming together that's also helping this particular type of trade. It's just interesting to see that this happened before. Another thing is this pound yen. So this is on a 1 hour now. Now, I think we can all agree that the pound has been in a short trend on this particular pair for a little while. We see that this market was becoming a little bit range bound. It gapped through on the Monday, and again, we spoke about this on that webinar, and then it came back up. And this is that example I had before where you really want to have that little bit extra percentage stop behind. So let's say you had your aggressive stop here. You would want to take the percentage of this candle and run behind it by a few pips. And notice how the market, it comes up, it almost breaks past this point, maybe even did by a few pips, but then it fully rejects within that 1 hour and then goes on and does it. And this is what traps 95% of traders. They come in, they see this trade, they place the stop, they don't place the adequate stop loss, and then the market quickly rebounds. You come in, you're seeing it close to your stop loss, you take the order out, you do all those kinds of things that they know you're going to do, and then by the end of that 1 hour, it's fully rejected and gone the other direction. And then you start to fall into the trap of things like revenge trading and those other problems that a lot of people have. So hopefully that makes sense, but what we want to do is we always want to use percentages whenever we're thinking about stop losses. Now, what about take profits? Well, if we're trading, let's say we consider this a channel and this is the length of that channel, then we really only want to be taking the distance of that for the break, okay? So you always, even though it went further than that, you always want to be looking at just taking what is there for you. Because getting greedy, as I said, the market's not a good teacher. Sometimes you're going to get more, but oftentimes it's going to come down here. If you don't take it, it's going to go all the way back, and then you'll start to do all the bad things like revenge trading and all of those terrible things that can happen to you. The other thing you can do, which the big guys do, is that when this market breaks, they'll also be looking at it and saying, well, logically, it could come down to this kind of area down here. So they'll be, let's say, thinking about this area, and they might place part of their order take off here and part of their order take off at this point. So that's called scaling in and scaling out. So in this case, we want to scale out. So that's a little bit of a tougher concept, but I think you can see what's happening here. When this level breaks, it's very key in the market. This was obviously a key support over here. The key support has been broken, so therefore it's on to the next zone. It's going to gravitate towards that zone. And finally, one thing that I guess the big banks will also know that you're not doing is create a business plan for your trading strategy. We do go on and on and on about this, but it's so important to do. We have a trading business plan that's called Presic. It's our system that's in our advanced course modules, and it kind of involves price action risk management, multi-time frame stuff, which is the ELD, chart patterns, indicators, and charting techniques. So we bring together all of these different reasons to be in a trade, and then we place it. And the reason we do that is because we know that's what the big banks do. When they're placing their hundreds of millions of dollars of orders, they're not just saying, I see a hammer candle, I'm getting involved. I see an engulfing handle. I see a Fibonacci retracement. they're bringing together as many reasons as they can, because at the end of the day, their jobs are on the line if they don't perform. So they must make sure that they're doing everything they can to place the trade that's going to have success. So always create a business plan, just like you would if you went and bought a business or you're starting a startup. You would always have a business plan. So you should for your trading. All right, well, hopefully that makes a lot of sense. I know I went quickly. I know I was, talking a lot. Unfortunately, Tyrone wasn't able to join us tonight, but next time, I think in the new year, when we come back, we will be both here, and we'd love to see you guys all come into the webinars as well. Do we have any questions in the room tonight? Lauren, are you there? All right, I'm not sure if Lauren's there, but I'll see if I can open it. All right, I'm not sure if you guys can see this, but I'll answer a few of these questions. Okay. All right, I've got a couple of questions here. I haven't had time to look through them too much, but yeah, Pepperstone will allow you to scale in and out. That's one of the questions that Royston had. They definitely do. If you're using MetaTrader 4, maybe MetaTrader 5, I'm not sure if it works on it, you can use their special advanced trading tools. Often, I think that has a scaling ability in it, so I'd definitely check that out if you haven't yet. Somebody asks, is it 200 SMA or EMA? So I've got an EMA on there. The reason that we like EMAs is because they are faster. So what an EMA does is it really puts a little bit more weighting on the last couple of candles, okay? And SMA weights it across the top 200, so that all of the 200 is averaged out. The EMA puts more weighting on the last couple of candles, and we like that because, of course, what are we trading? We're trading the current market. We're not necessarily trading the history. Somebody says they couldn't see the cursor. I apologize for that. It may be in the video when you get it sent out, so hopefully you can see that one. Okay, cool. This is a great question. So the hardest part of trading for me is sticking with a winning trade for long enough. Can you talk about some of the ways you can maximize a winning trade and ways to stay in it long enough? Okay, so the thing with sticking with a winning trade for long enough, and this is again what they really do know you all do, we all do it because we've had the losses, so it's in the back of our mind, well, I've had 100 pips come back before, is that you need to think about, well, maybe what's best is you're either risking a little bit too much, or you need to start being able to recognize in the markets when things are going right for you. So what I mean by that is, let's say we're trading the pound US dollar, okay? And we've shorted it at this point. Let's just say we had, and hopefully you guys can see this. What we will be able to do is we're actually, if it does come back to this point here and it's against us, then that's actually perfectly normal. What we'd like to see the market do is at this point, of course, turn around, and that's where we should see it turn around. Now, with your analysis, let's say you expected the pound going to, let's say this point here. What you can do is start to look for reasons why it's looking strong. Let's say the market pulls back to this point. That's actually going to worry a lot of traders that are in up here, because they're going to say, well, it was down here, it was up 100 pips, but up here it's not. Draw a Fibonacci off the pull and look at the retracements. A perfectly normal thing to happen within trends is that it'll pull back to a 38.2, a 23.6, or a 50 fib, even obviously the next one. But I like to see it usually pull back to the 50 and no more. So if it's doing that, you can have a lot of confidence that you're still trading with the trend. Check out things like the 200, become better at it. Another thing is, if you're trading live, why not have a demo account where you treat the trades the same way? So you just leave it in for the full take profit. This will mean that if you're editing it and stuffing around with it, at the end of the month, you can come back, well, how did my demo trade where I didn't actually touch my trades go? versus where I actually was manipulating it. And you'll generally find that you would be more successful with the demo trade. You'd be very, very surprised how often that happens with the students. All right, I think that's probably all I've got time for today. There's some great questions here, but unfortunately I am out of time. So next year we will be back. Hopefully you guys enjoyed it. If anybody does want to attend our webinar this weekend, we've got one that we're running on Saturday at 10 a.m. Australian Eastern Standard Time. You can just jump on fxevolution.com and we'll be answering a lot of these questions. So if you had a question and I didn't get around to it, I apologize. I'm doing it solo tonight, but ask that question in that webinar and I will get to it. Just say I had a question in Pepperstone and I will get to it as best I can. So thanks everybody. Hopefully you enjoyed it and have a very good night. See you guys.